Hello, this is ERic Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for July 12th of 2021. Please see our disclaimer for important information. As we have been starting off over the last several weeks, we give you high frequency data, courtesy of our friends up in Chicago, First Trust. You can see some of the data in the weekly analysis over in the far right column. We had a little bit of a drop off in the open table restaurant indicators, as well as TSA checkpoint and supply of motor gasoline, which is interesting. Gasoline data looks like it's a little bit dated, but we did get open table and TSA checkpoint data, looks like through July 5th and 6th, so it would have encompassed the 4th of July weekend, which we would have expected to see a little bit of a bump. But other indicators remain fairly strong. Rail car traffic seems to be off a little bit, but as we'll see in the next slide, overall data as it's tracking relative to 2019, again, before the pandemic, it looks really good. Don't really have any other specific comments on any of the rest of the data. Just generally speaking, the data looks good, especially if you look at the second from the right column, the month-over-month change. Now here's a quick snapshot on some of those indicators. Weekly retail sales continue to trend really, really well, and we see that we've got a fairly robust activity. In fact, we're in better shape from a retail sales standpoint than we were even in 2019. As you slide to the right, you get hotel occupancy. That's an area that we've really struggled. We've seen increased pricing power, and obviously here we've seen more rooms coming online, and so revenue per average room is going up, which is really good for the hospitality sector, allowing them to rehire employees and pay them better wages, frankly. And then down on the bottom, we have more of our industrial and manufacturing linked data points. Rail car traffic, as I mentioned a second ago, tracking really well relative to 2019, and steel production also. And we know that those numbers have been strong because we see the absolute and the relative strength within the manufacturing sector. Here's a quick snapshot on the, I'll call it the continuing claims number. Now there's a U3 and a U6 number that are published by the Department of Labor, and this is the number that shows how many continuing claims for unemployment insurance are out there. The one that gets published every week is the initial claims. And so what we're seeing here in the light blue is, frankly, the regular state programs continue to trend down, and we still have an influence from these pandemic-related programs that will begin to drop off as we go ahead. But as we've seen in some charts as recently as last week, that the reason why people are having a hard time hiring workers, it's commonly assumed it's because people are getting this extra unemployment insurance, but that is influential, but it's not the most important reason why people why companies are finding it hard to find hourly workers. But I think you'll see this chart begin to evolve and get back more to a normalized chart that really reflects that blue area and the influence that it has on the labor market. Here are a couple of statistics. Now, frankly, you look at these two and you say, well, they've got to be the same chart. Well, in some cases, yes, in some cases, no. In the left-hand side, we have the unemployment level divided by the job openings. And you can see in the shaded areas, which represent recessions, that this is following kind of a very interesting pattern, that we're exceptionally low. We're trending lower in unemployment, but we do have a lot of job openings, and that's maybe a little bit rare from this, is because you rarely see the spike and then the reversal is pronounced as we've seen it now. And that's just because we have a huge number of job openings. So on the right-hand side represents how well people are being able to hire into those jobs that are being opened up. And you can see with that number trailing off on the far right side, I mean, almost a falling off of a cliff, that's very symptomatic of there being a lot of job openings, but they're extremely hard to fill. So hires relative to job openings is very, very low. Quick check-in on home prices. This is the Home Price Appreciation Index. I believe it's published by AEI, the American Enterprise Institute. I think that really the read-through and the takeaway here is that we continue to see home price appreciation of an outsized manner for the near term, at least through the end of the summer as people try to get situated for the fall, et cetera. So be on the lookout for continued home price appreciation. Small business indicators. We've been talking about the fact that with the economy getting back on its feet, we've seen a lot of new business formation, but a lot of these new businesses, quote unquote, that are being formed are solopreneurs. They're DBAs, they're small 1- and 2-person shops. Now, small businesses in general, which encompass more than 5 people, we haven't talked a lot about them lately, but the small businesses that are open are continuing to trail off a little bit. So, and that's a really interesting development here, even though we're in this recovery. So, this begs more research, a little bit more delving into, if you will. But at a time where we thought that we begin to see that number trend back up, we frankly haven't. So, very interesting there. Mall visits. I think it's fair to say that the status of the mall is in somewhat flux right now, right? Because we've got increased purchases over the internet, electronic purchases, if you will, as opposed to physical in-store purchases. And we all know that the state of the real estate industry is going to change post-pandemic, and we kind of don't know how. Now, sales are recovering here in malls, as we see tracking from January of this year through June. So the difference relative to 2019, again, pre-pandemic, is improving as we go from month to month, but we're still down. And, the question remains and the critique remains valid whether or not we're going to see that really take hold and grow on a year-over-year basis. Corporate bankruptcies, again, another one of these oddities in the recession now. As we were sitting here last year, we were essentially a little bit more than 3 months into a pandemic, and I'll be honest, I thought that we were going to see a wave of bankruptcies later on in the summer and in the fall. It became clear that that wasn't going to happen, and credit quality actually remained fairly steady. Granted, we had a lot of government assistance, but in many cases it wasn't enough to keep the lights on. Obviously, a couple of slides ago, we showed you where small businesses in operation continues to trail off, but we haven't seen this wave of bankruptcies that I think a lot of people, including myself, were expecting. In fact, now, as the slide indicates, they've declined to a near record low. Very interesting, and I think positive development from the standpoint of business health, business spending, capital spending, and investment. Now here's another look on job openings. So I gave you some data a few slides ago on hires to openings and some visibility on that. Now this is just a flat job opening number and the openings rate, and you can see here, this is very healthy if you look at it from the standpoint of economic growth. It clearly says that we're doing well, that there's an interest in hiring, there's a confidence level amongst businesses that gives them the comfort of going out and looking for jobs. Now, obviously, as we've been talking about, the issue has been their inability to fill those positions. Quick check-in on the U.S. dollar. We've seen fits and starts over the last several quarters. We're at a kind of a trend line. If you look at this on a technical basis, we're kind of bumping up against resistance, and the next direction that you would think, if it doesn't hold here at this resistance point, is perhaps down. Obviously, there's a lot of implications for a dollar. A weaker dollar, tends to suggest that we could be importing inflation. A weaker dollar is good for commodities. It's good for emerging markets, and it's certainly good for equities because a cheaper dollar attracts more foreign investment. And we have seen an inflection point actually in the equity markets, interestingly enough, that we now have more foreign investment in our equity market than we actually have in a growth in the domestic side. Here's a quick look at the 10-year U.S. Treasury yield, and I just kind of want to move your eyes towards the upper half of this, and this shows you a 200-day moving average. And what's interesting here is we've actually had a fairly strong pullback in the 10-year Treasury yield at the same time that we've seen a little bit of froth coming off this inflation argument. Now the inflation argument is still out there, still valid. I think the year-over-year inflation numbers are still going to be positive, but yet it's interesting to see the degree to which we've seen a sell-off in the market. And I think there's some technical factors here. There are some supply and demand factors that are causing the yields to go down at a time where we're experiencing higher inflation. I think the degree to which rates are dropping is a little bit eye-opening, especially in the wake of this, the fact that we're getting close to the 200-day moving average. And if you look at both equities and fixed income on a 200-day moving average basis, when you punch through that moving average, you tend to continue along that trend. And so it'll be interesting to see if we hold here or if we break through the trend line. I tend to think that we probably hold here because there's nothing from an economic standpoint that should give us a lot of cause for concern, especially when we are literally on the eve of what should be a phenomenal S&P 500 earnings, a series of earnings releases by index companies and a lot of positivity on the margin. Here's a quick check as it relates to inflation on the left-hand side. So this is the 30-year break-even rate. And what does that mean? That basically is taking the Treasury inflation protected security yield and subtracting that, or measuring the difference between that and the 30-year Treasury. And so what we have here is a proxy for what the market thinks inflation is going to look like over the next 30 years. Again, a very long time frame. And so that number is right now about 2.2%. And you can see that it's come down about 0.2% here in the last couple of months after having risen dramatically over many months prior to that. The interesting thing with that as a backdrop on the right-hand side is that, with all of this rhetoric on inflation, we have seen a dramatic increase in investments in inflation protection in these so-called TIPS, or Treasury inflation protected securities. And we're sitting, what's interesting is that, we do have more inflation. Inflation expectations are dropping off, but we've got a lot of interest in inflation protection in portfolio management right now. This is a quick look at, and well, I should say it's better termed a reminder, something that we should all keep in the back of our mind, that when you have an inverted yield curve, and that means that basically longer term rates are below short term rates. So you basically take out the term premium and you're factoring in essentially a recession of some sort. It's a wonderful forecasting tool because the pink shaded areas represents the National Bureau of Economic Research. They're the ones who date these recessions, and you can see here, that these dated recessions have always been preceded by a large proportion of the yield curve being inverted. And so that's interesting. Now, the fact that we're seeing some flattening in the yield curve because these longer term rates seem to be coming down a little bit. So now we've got some more information in the fixed income market. So we've got a couple of interesting things going on right now. So we have a lot of issuance at the triple B level. So that's an investment grade credit, but it's marginally investment grade. We're not seeing a whole lot of issuance at the higher levels, and we're seeing a lot of issuance on the part of corporations wanting to maintain liquidity, but there's a lot more issuance going on at that level that's marginally credit worthy, if you will. And on the right-hand side, what's really interesting is, again, kind of waxing nostalgic here, as we were talking last year, we were really worried about the health of state and local governments and the fact that tax revenues were going to drop because of the pandemic and the shutdowns and blah, 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 blah. Well, as it were, state and local governments have actually fared really well, and they're taking this opportunity with low interest rates to really increase their municipal bond issuance. And you can see those in the blue bars towards the right-hand side. It's really picked up. And we haven't seen this kind of activity and issuance in over a decade. And it comes at a very interesting time as we emerge from the pandemic, giving a lot of state and local governments the opportunity to invest in infrastructure and take care of some capital spending needs. This is a chart on collateralized loan obligations, and CLOs and the credit protection behind the CLOs was a big part of the breakdown in the markets in the global financial crisis, because everyone just assumed that there was credit that stood behind these in the form of these credit default swaps, and that market actually locked up. Anyway, I don't want to scare you by that comment, but what we're seeing here is something that, it's an indicator that shows not only is there a huge spike in issuance going on this year, and these are collateralized securities that own loans that are being syndicated and sold on the secondary market. And they're essentially, securities that are pools of loans, if you will. In one respect, it goes to show that we've got a lot of loans that are being sold on the market, a lot of issuance, a lot of credit being extended, and the market is naturally taking this in a low yield environment where investors are looking for yield and looking for diversification, that they're getting it in these CLOs. Number of loan originations. This is something that we just got through talking about. So these are loans that are being, whether they be auto loans and leases or credit cards, we have more issuance. Now, the market, as we saw on that last chart, is taking this spike in issuance and originations here, and they're syndicating them. They're pooling and packaging these together and selling them in the open market. And kind of to wit, the reason why we're seeing a lot of this new issuance is because we've got lending standards that are becoming a little bit more lax. I think there's a lot of confidence out there with, and we'll see this in a second, with basically net worth ratios going up, debt to net worth from a household and consumer basis going down, and so that's giving a lot of comfort for lenders to loosen their standards. And these are relative indicators. So you've got on the left-hand side for consumer credit, you can see standards have gone down after they spiked last year during the pandemic. So in fact, standards are probably as low as they've been in the post-global financial crisis era. And then on the right-hand side, we have kind of a similar dynamic in play within the mortgage market. And the mortgage market, as we saw it coming out of the global financial crisis, was a little, I guess, more hesitant to relax standards than they appear to be right now. So very interesting. Here's that household liability chart, and this is household liabilities relative to disposable income. You can see this trend down, and so we're in this, we're getting ready to almost break the support level for this trend line here. And what this is telling you is that the ratios are really improving, that the households are in relatively good shape from a balance sheet standpoint. And again, this is giving a lot of comfort to lenders to loosen their standards. Even with the spike in lending and consumer loans, we're still well below trend line, which is evident in these two charts from the daily shot. So you can see that, we tailed off with the pandemic. We've recovered very nicely, but we're still well below that trend line, that multi-year, almost a decade-long trend line that was established after the global financial crisis. And you can see that not only from just consumer credit overall, but also in revolving credit as well. But granted, there are improvements, and they're encouraging improvements. It's just to highlight the fact that we still remain well below where we were when the levels we were tracking to pre-pandemic. Here's the S&P 500, a little bit busy because these show what we call Bollinger Bands. It's a little bit of a technical term. I won't go into it, but it shows you kind of the candlestick movement in the index. And obviously the trend line's been up. We really haven't had a whole lot of correction activity. This goes essentially to, more or less the beginning of the year. So, but we've hit resistance on these bands, and we are pulling back. So, I mean, from a technical standpoint, not to get too nerdy about all this, it was good to see that we didn't break through that, and that would have given me a lot more pause for having some type of a major correction. All right, so this is a chart that I actually alluded to about 5 minutes ago, and basically last year we have seen this inflection point where global investors own more U.S. equities than U.S. investors owned abroad, and so you can see that that's rarely been the case. Now, fixed income for sure. And that's definitely the case because rates in the U.S. have been even though from our vantage point they remain relatively low, but when you look across the world, when you've got a lot of trillions and trillions of dollars of negative yielding, even sovereign instruments, then there's a lot of interest in debt here in the U.S. and so. You can clearly see that here, but you can also see now that the equity market has shifted as well. All right, so we know earnings are going to be good. We're anticipating these earnings reports, but the first half gain in earnings for the S&P 500, again, emerging from this pandemic, is the 7th best data point in that series that we've seen in the last 100 years. So really rarefied air here in terms of earnings growth. And again, the caution here is that we don't get too comfortable with this rate of growth because it will slow. And we know it's going to slow as soon as next year. We've got a lot of year over year, what I call base year effects from the earnings being so low last year because of the pandemic. But this has been a very, very good year for stock and particularly stock earnings. So again, another chart on earnings here. This is the S&P 500 change in quarterly bottom-up EPS estimates, and we can see here in 2021 again following this is a quarterly change, but you can see after we kind of lapped the at least from a quarterly standpoint, the pandemic drop, we've been consistently positive, and what's really helping the equity market is you can see the highlighted part on the upper part of this chart. It's all, I mean, earnings over the last 3 quarters have actually accelerated in terms of the rate of growth. And on the bottom, you can see where that's coming from. Energy, Crude prices are up significantly year over year, and some of these um, emerging, I call them value components, were cyclically exposed components of the economy. You can see those there, even industrials, but you can see financials, materials, and IT, communication services, all showing very strong earnings per share growth. I thought this was kind of interesting. Daily net purchases of U.S. equities by individual investors, and this is coming out of pre-pandemic. I mean, this is going back to August 2019. And that was always a challenge for us as analysts looking at the influence of individual investors, as it always used to be these program traders and institutional investors. And that still is the case, but the influence from the individual investor standpoint, you can see here, has clearly gone up, and only continues to go higher as we get further into this year. And this will be an interesting thing to watch, that you'll have more volatility input from the individual investor sector. We were just talking a little bit about gasoline prices and oil prices, and here's a chart that and we've got a couple of things to show you here. Crude oil stocks are down. You can see the shaded area on the left represents the 5-year average for this particular point in the year. And where we are in 2021 is we're actually closer to the lower boundary of that. So crude oil stocks are low. And that's helping to support prices because we have increased demand for crude. You can see on the right-hand side, the gasoline numbers. Now, we had gasoline purchases in our high frequency numbers at the outset of this program, but you can see that we are hitting a record demand level for gasoline, which is really interesting. It also comes in light of this gradual transition to electric vehicles and whatnot, but lately, we've seen a strong demand for gasoline and other distillates that are produced when crude oil is cracked. But crude oil stocks being low is helping to support higher crude prices. Again, all these downstream impacts, obviously, companies exposed to crude oil prices are experiencing huge earnings gains. The credit quality of debt that's being issued by those types of companies is improving on a daily basis, and I think that's the main takeaway from this slide, is that the health of the energy sector, because of these supply and demand characteristics, is really interesting to watch. Here's crude oil production in the wake of these higher prices. Now, we always expected that when we did see higher prices, because lower production levels were firmly entrenched, that we'd see a breakout in production, mainly coming from a lot of these marginal producers who had capped wells when prices were lower. Well, interestingly enough, at over call it roughly $70 a barrel in WTI, or West Texas Intermediate crude, we have seen a little bit of a breakout, but it's been very minimal. So and I don't frankly think that this is enough right here in this chart to suggest that we're going to have relief on crude prices, i.e. Relief on gasoline prices at the pump anytime soon, unless this number, that little red dot, spikes higher to a meaningful degree. A quick check-in on used car prices. It's a very interesting dynamic. We've seen a lot of call them fleet vehicle sales coming out of the car rental the industry, I should say, and last year during the pandemic. So they were liquidating fleets to generate cash, and then now the demand has picked up and travel has picked up. They can't replenish their fleets soon enough. We've got choke points in the semiconductor industry which persist. So new vehicle production is low, but you've got, not only do you have the normal demand from an emerging economy consumer sector, but you also have the demand from this car rental industry, which serves as kind of like this additional demand driver. And what that's doing in concert is putting a huge amount of pressure on used vehicle wholesale prices, and you can see that very much in evidence here. And I'd like to end on this slide, and this is just mergers and acquisitions. It's the value of transactions on a global basis, and it's interesting to see here in 2021 that we've seen a lot of activity. So there's a lot of capital being put to work to combine businesses, and this is a global number, so it kind of reflects what's going on in this global recovery, which is perhaps not as synchronized as we thought it might be, but that has a lot to do with vaccination rates across geographical boundaries. But what's really interesting and I think positive to see is that there's a lot of activity going on in mergers and acquisitions. And in some cases, you might be a little worried about this in the sense that you might suspect that if companies there are no internal reinvestment opportunities, that they're going to simply take that cash and go out and buy companies, and that would be kind of maybe a signal of being later in the cycle. But I don't think that's at play here. I think this one is that I think this is a rush to globalize and to reach new markets by virtue of acquiring companies and markets and industries and industry segments that are attractive to companies on a global basis. So my takeaway is entirely positive with this spike in activity. That's all we have from our chart pack today. So I guess really to briefly summarize, we continue to see strong trends in the economic data. The high frequency data is really strong. We've got an emerging economy that we've got a lot of businesses that are looking to hire. They still can't hire in many cases, but at least job openings are going up. Long-term unemployment rates are continuing to drop. We've got optimism on the part of S&P 500 and large companies, whether they're private or public. And we do feel like earnings season is going to be really good. Good news is the equity market is kind of peeled back a little bit. So we're not as frothy as we have been, although Friday represented a strong rebound from the anxiety from Thursday when Japan decided to go to emergency status on their pandemic, and then basically kick out spectators from the Olympics coming up. But the overall backdrop remains positive, and I think we can hang our hat on in the coming weeks what executives are going to say for public companies in their quarterly releases. And I think we still need to worry about inflation a little bit, keep it in the back of our minds. Obviously, a lot of investors are, but just understand that the inflation numbers that we saw in the last round of releases is probably not going to be the same type of inflation numbers we're going to see going forward. So all in all, I feel good about the backdrop and welcome your comments and your feedback at the information you see here. On behalf of the entire team, I hope you have a safe week, productive week, and we will see you again soon. Take care.